Hi everyone, my name is Frank Paul. I'm the developer of the course and service entitled Forex Profits with COT, an insider's guide to the secrets of the commitments of traders report. I say course and service because this product encompasses both a core educational component that runs well over 5 hours long, as well as a weekly market forecast subscription service. I'd like to invite you to find out more about this product at www.forexmentor.com/COT. What I'd like to do here in this brief mini presentation that'll probably run about 15 to 20 minutes is talk about a rather unorthodox aspect of trading with the COT, and that is what to do when commitments of traders data is giving you either a lack of meaningful signals to work with, or is perhaps even giving you signals that are running contrary to what you see in your technical analysis of your charts. And this will be a pretty good case example that demonstrates some of the things we do in the Forex Profits with COT presentation that will help you navigate through the market even when COT is not helpful. I'm sure a number of you know from past experience that we have to wait sometimes weeks, if not months at a time, to get very profound, meaningful divergence signals. So the question is, what do we do in the meantime? Do we just throw our hands up in the air and not trade? Or are there other things we can do? And the neat thing about Forex Profits with COT is that we combine both commitments of traders data analysis of that together with Elliott wave analysis. So even when COT is quiet, we can often determine where the market is going to go with reference to Elliott wave. And when we combine those two approaches and they tell us the same thing at the same time at important market tops or bottoms, of course that is very powerful. So without any further ado, I'd like to now proceed into our presentation. To start off with, I just wanted to reference a customer testimonial I've received. This is an actual email, cut and paste, so you can read the comments verbatim. This is from Suresh Karela in Michigan, and Suresh has reported some really good success writing put options on the Dow. We're not going to get into technical details of options contracts, of course, that's way beyond the scope. But I just wanted to present this to demonstrate that the information we're going to look at here in the chart examples and so forth is not strictly theoretical or abstract. This is a practical trading information that we're talking about. And here is just a first-class example of how somebody has taken those forecasts and used it to great advantage. Now, just to set up our example with a little more detail, the dilemma, what to do about the Dow, we'll get to that in a minute. I first wanted to present you a little bit of information about this example. The Dow Jones Industrial Average is one of 4 bonus markets that we cover in our weekly subscription service, the other 3 being light sweet crude oil, the spot gold market, and the spot silver market. The focus is definitely on Forex, so don't worry yourself by this example being focused on a non-Forex market. Of course, our primary focus remains there, and we look at a total of 9 different markets, including the US dollar index, the 7 major US dollar denominated pairs such as pound USD, euro USD, etc. And finally, as a result of overwhelming interest from our subscription base, we recently added in the pound yen cross pair. What you would need to trade the Dow, if you have a broker that's full service, in other words provides access to not only the Forex but also commodity futures markets, you would be able to add or set up a supplemental trading account quite easily. And there are at least 3 main ways I can think of to trade the Dow. One is standard futures contracts, the E-mini style futures, which enables you to get into this market with a lot less margin requirement. And finally, options, which is the technique that Suresh used in his example that we just looked at. Now, what would be the main reasons why you would consider trading the Dow if you're primarily a Forex trader? Well, first of all, let's say you have a portfolio of stocks, and let's just say, for the sake of argument, you're planning to hold on to them for a long period of time, perhaps as part of a retirement savings account of some kind. Trading the Dow in the interim, in the futures or options realm, will allow you to capture profit, let's just say in this example, when the market is heading south and you're able to go short the market. Of course, the value of your portfolio will come down in that interim period, but being able to grab the short move outside of your stock portfolio is a nice counterbalance to that. So even while there's a bit of a drawdown, you can still profit in the interim. Another reason is that the Dow is just a wonderful market to watch. It is the most widely watched market in the world, without a doubt. A fantastically useful barometer of overall market health, and it provides a number of excellent technical trading opportunities, just like Forex does. Now let's get back to our scenario here. In this example, I'm going to show you the Dow had been retracing from March 11th through to May 2nd, so a period of almost 2 months after an initial 2 waves down from its October 2007 high. So we're in a bullish market, or so it seems, retracing, heading to the upside. Now, as we head into spring, late spring, early summer, the last clear COT signal that we had was on the 8th of April, and it was a bearish divergence. So, a bearish signal, but coming in the midst of a market that was heading in the opposite direction. So this is the dilemma. Let's just say we're heading into May, June, that time frame there. What do? The market is obviously rallying, yet we haven't had a recent COT signal. The last one we had was bearish. So should we have simply jumped onto the short side of the market as soon as we saw that COT signal? And the question absolutely was no, not at all. That's not what we should have done. So what should we have done? Well, let's see if we can piece this thing together. Well, the first and most obvious thing that we would do is top-down analysis, and this is something we provide every week on all 13 of the markets we include in our subscription service. Top-down analysis in a very high-level time frame, dealing with the monthly, weekly, daily charts. We do not delve any further lower down than that into the intraday time frames, simply because the service is provided once a week, and it's really, to get into intraday time frames just would not be useful. We're really looking for high-level structure here. So what we do is we try to figure out, well, where are we in the grand scheme of things using Elliott wave analysis? Where are we vis-a-vis a trending market or a correction market? And that provides a lot of clues, and also when we get some good wave counts going, then that can open up some good price projections or objectives for trades. So we're going to look towards the right-hand side of our chart here. June is, of course, the most recent candle, still not fully formed yet. And then, so for the sake of this example, we're right up here in May, let's just say. Right here in May. So the high-level structure, what you would have heard me talking about in the monthly chart review, is that the October 2007